Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at our proxy for the S&P 500, which is the SPY, and we're also going to go over and have a quick look at the Dow Industrials as well. Now you'll have to excuse me, I'm still recovering from the flu at the moment, so my voice is a little off and I've still got a bit of a sore throat, but I'll do the best I can. So let's start with our Elliott wave count and then talk about the recent price action. So, quick reminder, we've been talking about getting this primary wave 3 complete for, well over a couple of months now. My initial suspicion was that it would come in late August during the summer. It never arrived. It continued to just extend and push further, and then we started to sell off around the start of September. But we're not sure really until until yesterday, really, what we were dealing with here. And now I'm very much of the suspicion that we've achieved that target. We've reached our top of our primary wave 3. We're going to look at all the basic technical analysis with the Elliott wave today rather than at the end of the video, so I can help confirm why I suspect this is a major reversal. It's a market peak. It's not the market top. It's just a peak. I still think we are going to come down into a wave 4, and then we're going to push up in one final melt up into a wave 5, probably out into next year, and then that will be the completion of a very, very, very long bull market going all the way back to 2009. So 2009 to 2022, the longest one in history that will be. There is the possibility the market has topped here, although I don't think that's the case. I think it's just a temporary peak before we move higher. So we get our way up here from our zigzag here at the primary wave 2, and so we're expecting an alternate correction here at the primary wave 4. Now this could be a double combination. It could turn out to be a triangle and be quite time consuming possibly. It could also turn out to be a flat pattern, and the exact type of flat pattern, whether it's a regular flat, running flat, expanding flat, won't become clear until we finish the first move of the pattern, really. So if this is primary wave 2 back here as a zigzag, then we will be expecting an alternate form of correction to a zigzag up here at the primary wave 4. You can't have a triangle and a 2, so only the triangle could occur here in the 4 as an option. Now I decided and put this on the chart. Well, I've been looking at this now for over a month, which is the idea that this was an expanding ending diagonal. Now it's about the only fit I can really get. We have a 3 wave move into a wave 1, and then we have our zigzag into a wave 2 here. We then have another zigzag into a 3 which is longer than the wave 1, and then we have a zigzag into a 4 which is deeper than the wave 2, and then we have a wave 5 which is longer than the 3. So that fulfills all of the criteria for a diagonal, and we failed to reach the trend line, the upper trend line, with the completion of the 5, where we did with the 1 and the 3 here, or where we did with the 3, we didn't with the 5. This is also very, very normal for an expanding diagonal to have that failure of reaching that upper trend line and then breaking down. Okay, so that's essentially the first Elliott wave count, which is the idea that we've topped at the primary wave 3. We'll look at the other one in a moment. I just want to bring up the RSI and the MACD here. Now I know we normally do this at the end of the video, but it's important to point out here the significant change that has occurred and why the constant narrative of buy the dip, buy the dip, buy the dip will turn out to be correct, I think, again, although this dip's going to be a deeper one and a better opportunity for bulls to get back in. But listening to a lot of the people I know, I've seen the same old bears come out of the woods who's like, this is the top, this is it, we're crashing. But then again, I've seen the same old well-trained bulls come out recently who've already brought this, and they should get a bounce from here, so they'll probably convince themselves that they've done the right thing, and as long as they're not over-leveraged or overexposed and they're trading sensibly, they should be fine anyway. But there'll always be those who've just gone balls deep right here, and if the market does collapse lower, it's going to hurt them. Okay, so what makes me suspicious that the market could still move lower from here. Well, if we look at let's bring up our moving averages as well, and I'm just going to hide the count for a moment. We can come back to it in a moment. Just bring up our moving averages. So the first thing which really stands out is this gap down through the 60. So if we look at the previous 1, 2, 3, 4 dips we've had here, we've stayed above the 60 exponential moving average the whole time. Okay, we've come close to it, but we've never broken it. The coiling up of the 10 and the 20 here, which is the 10, which is the yellow and the blue exponential moving averages, they don't cross. They come to touch in one place. They come close, reverse, come close, reverse, come close, and reverse. Okay, they do not cross one another. In this case, the 10 has crossed through the 20, and price has moved below the 60 for the first time since. Well, we haven't had a gap like this down through the 60. Since back here, where we almost filled it with the we had a hammer, came up to fill the gap, came back down, and that was back in September last year. We also had a gap down here, as well, which we came up to fill. So that was on October last year, the last time we gapped through the 60. So it's been a while, roughly a year, since we've had that kind of aggressive move lower. So we'll wait and see what this turns into, but this is a sign that this is a more significant correction. Now, it doesn't have to be particularly deep, it's just a more significant correction in terms of it happening on a larger wave degree. So this is our primary free up here, and these are all smaller waves of it, which haven't resulted in such a strong sell-off. We can also see with the RSI, this is our first move down into oversold territory, also since that same period. We didn't quite make oversold actually back in October last year. We just stayed just on the line. Here's the RSI, which shows the green level at 30 is oversold, the red 70 level is overbought, and we can see that we didn't quite make through the green line on either of these occasions. We haven't actually had oversold conditions since the crash down into March of 2020. So this is the first sustained move lower, or significant move lower. So also symbolising that this is something more serious than these little dips we've seen prior. So likely to result in further downside. I think the gap here is likely to get filled. I mean, we had a thrust down for the open of the week, so we will likely spend some of the rest of the week coming up to close this gap. It's likely we're going to want to push up into these moving averages or try and get above them, but the likelihood of making another high, having had this gap down through the 60 here, is unlikely now. I think we've started a selling off process, and we're likely going to move around and find our way lower. I mean, this could be the first three wave move of a flat pattern possibly before we come down much lower. We don't know. That's if we were to get a flat pattern. This could be the start of, a triangle perhaps, if this is assuming that we're in the primary wave 3, of course, and therefore we have limited options. We can't have a zigzag up here, so maybe a 3 wave move, then a 3 wave move, and a 5 wave move possibly. That's one of the options. Another thing I'll point out is, if we observe the MACD for a moment, and we just point out the zero bound. Okay, let's flatten the screen a little bit, and we'll just put a line across it. Okay, so you can see how since October, like I said last year, November and October last year, that's where we got these thrusts below the zero bound, here and here. All price since then has been essentially, we had one small one back here in March this year. Okay, so but most of the price action since then has been sustained in positive territory, and now we've had a move back below it. So we've had a move back below the zero bound, so into negative territory on the MACD in the first significant way in a while. So that's also a sign that these little dips we've seen recently since June back here, this little dip, this little dip, this little dip, this little dip, are not the same as this move now, which is of a greater degree. Obviously, another thing we can point to, which we've mentioned previously, let's just pick up the RSI here on the daily time frame, is if we give, I don't think we can work from? Let me think. This is the March oversold condition. So working from the peak here, having gone from oversold back to overbought to neutral to a high, I think we should work from this high, and then from here you can see that there's divergence. So it's a high, lower high, lower high, lower high, and now we've had this breakdown into oversold conditions. Okay, so this is strong divergence that we've seen building up on the daily time frame. It's only present on the SPY, on the SPY here, on the daily time frame. It isn't present on the weekly time frame, not clearly at least, and not as strongly. But yeah, we've had a series of lower highs in the RSI and a series of higher highs in price, which has finally led to this correction beginning. And yeah, so there you go. I just wanted to cover those things there. We've had our divergence on the RSI on the daily time frame. We've had that move into oversold conditions. We've had that move below the zero bound. We've broken the 60. We've gapped through it. We've crossed over the 10 and the 20. So there's all the signs here to show that this is a more significant correction that's about to occur. There's just one other thing I want to look at. Okay, and volume supports it as well. Okay, we should always look at volume. And we can see how, as the sell-off has been increasing in severity, volume has actually been coming in to the market to support the sell-off. Okay, and it's quite a strong reading. We've seen here with the bounces though that we've had quite. I mean, this was a bit lackluster. This one here. This one was pretty good, this one was pretty good, this one was pretty good here where we've had these bounces. So I do think now that we've had this increasing volume in the sell-off, we will now have a bounce, because I mean, we don't have to, I will say that. You can just create a gap and then woof, you can just go without having to come back up to fill it, but it's much more common to come up to close the gap, test it for resistance, and then continue the sell-off. And then there's of course the final one, which tends to catch out the bears, which is we create a gap, we come up to test it, we look like we're falling down, and then we come up to make a new high. You know, any of these are options. We've seen how resilient this market's been, how bullish it's been, but I think for the first time in many months we can observe now a reversal of conditions, at least for the short term. Yeah, we've seen reversal of conditions into a more negative setup. So there you go. So now that we've looked at why it is we think we're now in a more significant correction, we've broken this trend, we've broken this major moving average. Let's just put the indicators away for a moment. Let's I've already got the volume once, haven't I? Let's hide this one then. Okay, let's get rid of our moving averages for a moment, and let's consider an alternate count, a very old one, which was my initial count going back, God, months and months. And that's the idea that the market's peaked. Now, where are we? Alternate count. Now, this is not fleshed out at all. I'm not particularly confident in this. I think it's more likely we've topped in the primary 3 with a 4 and a 5 to come into next year. I just think that the level of bullishness from retail and the general love of the stock market and the confidence in the Fed at the moment can't be shaken by a little sell-off like this. This could cause temporary little bit of panic, but the buy the dippers are strong, and they're not going to want to call end to the party. So it's just, I think that is what's going to get us up into a 5th and final thrust once this 4 is over. The attitude that the market will not be allowed to fail, that will become a self-fulfilling prophecy and will push up to another high. But we've got to get the correction over with first. This is an alternative. This is the idea that everyone's going to get caught by surprise. The market's already peaked, and this is just leg 1 down of 5, of 1, of 5 waves down to a new low, which would come down at least, I think, to test the low back in 2020, March 2020, giving up roughly 50% of the market in terms of value. Very extreme. I expect this to happen eventually once the bull market's over, but I don't think it's over yet. I think that we've got the 3 is now likely in. We've seen a reversal of conditions, a change of conditions to more negative, or at least neutral conditions for the moment. in comparison to the extremely bullish conditions we've been observing. A move down and then a final move up into next year is what I'm considering to be more likely the case. Alright then, so let's pop over now and have a quick look at the Dow as well. Now, I've got 2 counts on the Dow as well, but this has been a bitch the whole time in terms of trying to get an impulse onto this. Trying to get any clear count onto this has been very tricky. The S&P hasn't exactly been a wonderful thing either, but we're seeing much weaker, or we have been observing, I should say, much weaker conditions in the Dow than we have been in the SPY. So, excuse me. Same idea, topped in the primary 3, but we got a contracting ending diagonal with a truncation in the 5th. So rather than getting a throw over in the 5th, we failed to make the edge of the trend line, and we basically did this in sympathy with the SPY, even though we were looking at separate patterns. So we've got this 1, 2, zigzag 3, zigzag 4, zigzag 5 fail at a truncation of the 5th here, and then we start the breakdown into a 1, 2, 3, 4, 5, potentially into a wave 1, and then now likely to retrace up into a wave 2 before heading lower again. So we'll have to, now we don't have the same restriction here in the Dow that we have in the SPY, because we had a flat pattern here, a regular flat in the 2. We didn't get a zigzag, we got this A, B, C to a lower low, B retraced 90%, and we have 5 waves in the C. So this could be 5 down into an A, so we could be working on something like A, B, C into our wave 4 before coming up for that wave 5 later into next year. So we don't have to do the same correction is what I'm saying, as we're doing in the SPY. The divergence in the RSI has been here as well, where we've just had these weaker lower highs, and especially more recent price action. If we go back to June, or May to June, we can see that we've had a high and a lower high, and a series of lower highs here. Price is broken down, and one thing that I want to point out here while we're looking at the Dow is I just want to compare it to the DJT for the moment. Okay, so one of the things which is quite impressive is just how divergent the price action became between the Dow and the DJT here. If I just, let's just get rid of the counts for the moment, and let's get rid of all these little trend lines so we can see more clearly. Get rid of that piece of text, and we'll just switch the chart into lines so you can see what I mean. So as you can see, we're pretty much in lockstep with one another. The blue now is the industrials, the orange is the transports, and we can see how, if we go back to the crash in March 2020, we had a high and then a lower high in the transports, and we had a high and a higher high in the industrials, right? So we had divergence. Now, small divergence, but it led to a 30% crash, right? So this was just one of those occasions where you don't get much warning, where there isn't much technical underlying warning of what's to come. We had this small divergence, and then this came along and knocked the wind out of everyone's sails. Now, this time we're getting a much bigger divergence over a longer period of time. So that this thing has been warning us for months, since May. Here's the peak. We both peak at the same time, right? The industrials continue higher, but the Dow Jones transports have been doing nothing but selling off since. So this was a huge underlying divergence, Dow theory sell signal here, where we've got divergence between what the transports are doing and what the industrials are doing. And now if you look at them, they're now back in lockstep. This move here, this move here, this move here, and this move here. We're now back in lockstep with one another. So we saw this divergence building, and we rejoined one another here. This is when we linked back up with the same price action, and this was on August 21st. So since August 21st, the fate of the Dow, as in terms of there being a downward move, has been sealed, and was going to happen no matter what. And we've now seen that play out. Now, how deep we go, let's discuss some of the targets we've got. So we're just going to tidy things up a little bit here. We don't need that anymore. Okay. So we've got our wave 4 supports here. Now I might need to just double check that these are still relevant, as it's been a while since I've adjusted them, and I want to make sure that it's still in the right position. Okay, so let's just get the count back up. Okay, so assuming this, and this is what we're assuming, is that this 3-wave flat pattern here was our wave 2, then we're looking for retracements from here. Yep, so the market's pushed up a little higher since I last updated these. So it looks like that we may already, we haven't quite done it, but we're very close. So let's just shift this line up. Okay, and we'll shift the price up as well. Okay, and we'll do the same with this one. Unlock it. Move it up to the 38.2. Okay. And then we'll lock these back in place. And we'll just make sure we're being more accurate with the price here. Get it right on the line. And we'll lock these in place as well. So these are the first supports. Let's delete it. These are the first supports to be looking at. Pretty close to the 23.6 already. Which could suggest this won't be a particularly deep correction. I mean, we have our prior wave 4 here, right? And it's quite often the case that the greater wave 4 will correct into the prior wave 4 territory. We've already done that, and we've already come round to the 23.6 area. I think it's likely we're going to be a little deeper this time, with no guarantee though. Likely going to be a little deeper, but either way, whether we complete it very soon or whether we come a little lower, when we do get that completed wave 4, I think that's the final opportunity up into the top of what will be the bull market. If we break the 23.6 and the 38.2, then we'll look for the 50 even lower. And the only thing which would make me suspect that we could go lower, although I think it will get filled once the bull market completes, is we've got this gap back here, which has not been filled. Okay, so whether that gets filled now, unlikely, because that would invalidate the count, bringing us below the wave 1, which would mean this would have to have been the market top. So this will likely get filled when the big crash comes all the way back down to the lows, but that's probably a fair few months off, if not longer yet. One alternative for this is, I've got two of them for some reason. Well, we know they're the correct ones now, so let's delete them. Alright, so one alternative is that the market has peaked. We talked about that in the S&P, and the best way I can get up here is part of a very old dead Dow idea I had, which I spoke about a long time ago, which is that wave 4 at cyclical degree never actually completed, and that this entire move up has been a wave B. So we had this, the idea was that we had this thrust down in an A, big move up in a B, and now we'll do 5 waves down in a C. I rate this as highly very unlikely now, because of the way price action has developed since, but it is still a possibility. It's just less likely because of what we've seen the other indices do, which don't have any correlation with it. So we'll have to wait and see. Alright then, is there anything else I wanted to talk about? Let's just have a look at the setup over here for our moving averages as well. Do some basic analysis here. We want to switch off that zigzag count. Come out to the daily time frame, and yeah, it's a very similar story again as we've seen in the SPY. We're dealing with a more significant correction at a greater wave degree, because whereas the 60's been acting as support again, here, broke it here, support here, we've broken through it this time. And we've got that crossing over of the moving averages here. We've got that 10s crossing through the 60. The 20 is just behind on its way through as well. We haven't seen that any time since all the way back here in November 2020, same as the SPY. So the fact that we're doing it now, we're coming through the 60 exponential moving average like we did back here. If this is 1, 2, it therefore makes sense that this is 3, 4, doesn't it, that we're working on now, and that these two corrections are related to the same wave degree, and therefore will result in that final push up into a 5. We could come down to test the 250. We did it back here at wave 2. Right, so to do it again at wave 4, we would still be totally valid, a long way off Invalidation, so that would be a perfectly acceptable place to come to as well, which would be the 250 exponential moving average. And oversold conditions now on the RSI, so this supports a bounce in the short term. We could bounce up and then continue lower. And let's just come back over and have a look at the SPY. There was a couple of other things I wanted to share before I go. Let's take the count off. So, working on the premise that we have had this 1, 2 as our pivot, but we had it as a zigzag here because we didn't set a lower low like we did in the Dow. You can see how a severe or deep correction isn't necessary. If this is 1, 2, then 3 and 4 could still stay perfectly happily inside of the pitchfork here off of the 1, 2 pivot. 1, 2, 3, 4, and then we can get all of them complete inside of the same trend, and then we'll have that huge sell-off most likely next year. Alright then, so there you go, geometry still intact. Now if this breaks down and we come out of the outer bound of the pitchfork here, and we come out for the extreme outer bound of the pitchfork here, and we start taking out all these levels, 23, 38, 2, and we don't even bounce off of the 50, then there's only one level of interest left which we have to observe, and that's wave 4 invalidation. So let's just pop that up here now, and that's at the top of this wave 1 here. Put a white line, save it, and we'll just hide this pitchfork out the way as well. Okay, and this line represents the cutoff. Now I don't see us coming all the way back to here at all. I probably don't think we've got all that much more to do. Even a test of the 250 would leave us a mile away from this thing. But just in case all that market geometry breaks, that pitchfork breaks, and we continue to thrust lower, and we start taking out the 38.2, then we take out the 50, then this is the final cut-off point where if you don't find support before this, the market did peak, it was the completion of the bull market, and things are going to continue to get considerably worse. Okay, and we'll just save it like that. Alright then guys, I think I've covered everything I want to cover. We can't really pick into this correction in the meantime, and not until we get a little bit more price data. Like I suspect, I think we're going to bounce to fill this gap. Once we start to see some observable structure beyond what is essentially just a bit of a mess at the moment, maybe we can start putting a count on it. We seem to have a clearer 5-wave move down in the Dow. We don't seem to have any such clarity here if we just come into the shorter time frame. Here's 15 minutes. It's just a bit messy. This is at the moment. You could argue that this is a 3-wave move. We've done the first 3-wave move of what will be a greater correction, and now we're going to come up, and then we're going to come down. That's a possibility. Maybe you could argue for a diagonal into here, and say that this is a 1, 2, and this will be a 3, 4, and this will be a 5 into an A, and then we'll have a 3-wave move. We'll have to wait and see. It's not particularly clear at the moment. The only thing that is clear is that we are correcting at a larger wave degree, I think, and we have a lot of strong evidence from our indicators, our moving averages, our divergence, and support from volume to suggest that this sell-off is at a higher wave degree, and therefore we are finally completing this primary wave 3 we've been talking about for months. Alright then guys, thank you for joining me on this technical analysis of the SPY and the Dow. Excuse me. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And as always, thank you very much to my Patreon subscribers. Your support is greatly appreciated. If you're interested in becoming a patron, there's a link in the description below. Head over, have a read of the different tiers and offers that are available. And also, if you're not following me on Twitter yet, there's also a link in the description below. Alright guys, take care, and I'll be back with you later in the week. All the best. Bye bye.